Welcome to the Chachanomics Money Talks. Dear viewer, this is the channel that talks about personal financial matters, for example, saving, investing, making use of debts, or making loans work for you, protecting your assets, among others. In our previous sessions, we have been talking about best saving and investment opportunities for campus and college students. We did talk about the importance of saving, the importance of investing. Today, I want us to look at the differences between saving and investing. I am the lead trainer and founder of Chachanomics, as you know it. I'm Chacha, go to Bichang'a, a personal financial coach, a mentor, a leader, and the author of a groundbreaking personal financial manual called Mastering Your Money. Basically, the issue of saving and investing is very crucial to attaining financial freedom. In other words, one of the best ways of mastering your money is by knowing how to save, how to invest your money. Remember, as we did say last time, that the money speaks one language. Save me today, I save you tomorrow. Then what is basically saving and investing? Saving is the practice of putting aside a certain percentage of your total income for a certain purpose. The purpose can be for emergency, can be for school fees, can be to cater for irregular expenses. For example, you have had a puncture, or your car has had a problem, or any emerging issue. You can in fact save for other reasons like retirement. You can save to fund an investment project. So basically, saving is putting aside a certain percent of your money for a certain purpose. Then what about investing? Investing here is not just putting aside money for a certain purpose. It is making your money to grow. It is multiplying your money. In other words, investing means making your money work for you. How? This is by leveraging on the amount of money you have saved, so that now it can generate cash flow. It can generate profits. It can generate regular income that it can fund most of your expenses. So in other words, saving and investing, they look more or less the same, but they are different. In what sense? For saving, it is mostly for short term. For example, you can save for 3 months, you can save for 6 months, 8 months, or 12 months. For example, if you are saving to buy a good gadget, electronic gadget, you want to buy a laptop, you want to buy a good phone, or whatever, you can save, for example, for 3 months, 5 months. For example, you want to save 5,000 shillings or 50,000 shillings in 5 months, meaning that you can save 10 per month. I know that is a lot of money for especially college students, campus students, hustlers who are tamarking, those who are barely eking out a living. So for investing, it ranges from medium term to long term. Medium term means investing can be for 2 years, 3 years, 5 years, or more than 5 years, even 10 years. So saving, as we have said, is short term, while investing is for medium term and long term. The other second major difference is that saving may not be necessarily goal-oriented, but investing is goal-oriented. What do I mean? In other words, you can save even without a goal. In fact, if you have read a book called The Psychology of Money, it says save even without a goal. Yeah? But we are not saying that therefore when you are saving, you shouldn't have a purpose. You can have a purpose, or you can save for the sake of saving. But for investment, because you want to grow, you want to multiply your money, therefore you must have a clear-cut goal. So how do you achieve that goal? You have to sit down and say, in 2 years, I want to save, for example, to buy, let's say you want to buy a car, you want to buy a bicycle, you want to do a certain project. Therefore, you can put your money in a saving and investment vehicle, whereby by 2-3 years, you will be able to get good returns. The third difference is that saving is less risky, while investing is risky. What does it mean? When you are saving, you don't want to lose your principal. your capital, right? Because you are saving, for example, for emergency, for fees, or to buy something. But when investing, you have to be a risk taker, whereby you can either lose your money or you can gain. So when you are taking risk here, it's either you gain or you lose. But even if you lose, you should not give up. In other words, there are various saving and investing vehicles. For saving, you can save in a bank account, you can save in a telecommunication digital wallet like M-Pesa. You can also save in, you can save even in Chama. You can also save in a circle and so on. But for investing, because you want your money to multiply now, you can invest your money in business. You can start a side hustle. You want to buy or sell certain goods of a certain service. So therefore, for investing here, you can put in various vehicles. It can be a business. You can invest your money in the stock exchange, what we call in the Kenyan context, the Nairobi and the Securities Exchange. You can also put your money or invest it in government securities, that is treasury bills and the treasury bonds. So you can also put your money in real estate, forex trading, in digital currency like the cryptocurrency you hear about, the bitcoins, etc. So as we say, therefore, saving is less risky, investing is highly risky. When it comes to returns, investing has more returns while saving has less returns. Because if you are saving your money in a bank account or in a money market fund, therefore, the returns are very low in terms of the interest. But for investing, the returns in terms of profits, dividends, and interest should be above the rate of inflation, for example, above 10%. And that one you can only get it in treasury bills, treasury bonds, even stocks. Even if sometimes stocks go up, they also go down, they can multiply your money, especially if you buy shares when the prices are low and you wait for some time, a few months, the prices maybe they double. Therefore, your money is likely to grow fundamentally. So in that case, what we should do, save with a purpose, invest with a plan, and satisfy your risk appetite. That is the rule of the thumb. I repeat, save with a purpose, invest with a plan, and satisfy your risk appetite. Risk appetite means, are you a risk taker? Are you an aggressive investor? Are you a conservative investor? Or are you a moderate investor? If you are a conservative, it means you don't want to take risks. So you put your money in less risky instruments or financial vehicles. For example, you put it in government securities, treasury bills and bonds. Maybe you put it in a money market fund or a unit trust for that matter. But if you are a moderate investor, you put it either in instruments which are not highly risky or which are not even, do not have risk that is actually too low. But if you are an aggressive investor, you don't mind losing, but what you focus on gaining. So dear viewer, I know we would have talked more about one of the best saving and investment vehicles, that is money market fund and so on, but that one I will reserve it for the next session of our Chachanomics talk show. For now, I would like to urge you to stay tuned to the Chachanomics Money Talks as we enlighten one another, as the Bible says, iron sharpens iron. Thank you so much. Stay tuned to the Chachanomics Money Talks. Can you share? Click the link that is on your screen. Chachanomics is the place to be or to visit so that you can be financially enlightened. Thank you so much.